Hey there, Ed McCormack here, founder of the crypto education platform, Dchained. Before we start today's video, I'm obligated to ask, if you haven't already, please hit that like button, subscribe to the channel. You know the drill. We appreciate all the support we get from viewers like yourself in helping spread the word. So with that being said, we're off to a phenomenal start in November. Prices are hitting all-time high. People are feeling good. Investors are coming into the market in droves. With that being said, it's also drawing in a lot of scammers and snake oil salesmen to ultimately try to take your money in a practice called rug pulls. And in this video, what we're going to teach you are 3 of the common ways that rug pulls occur and what you could do to spot them and avoid some catastrophic loss to your investment portfolio. And we're going to talk about all of that right now. So before we jump into what a rug pull is, let's talk about one of the terms I just mentioned, which is snake oil salesman. It's a very weird term, but it goes back to the 1700s when the first patents around medicine started to become commonplace in England. And at that point, there was no regulation in regards to what the doctors or these salesmen could ultimately advertise as part of these anecdotes and these herbal remedies that they were pushing. And ultimately, it drew the moniker of these fraudulent, false claims, ultimately just vapor that these guys were selling. And it's something that we've seen over the years, all the way going through the 1920s, which ultimately led to 2 of the biggest securities laws that we have that run the entire stock market. Securities Act of 33 and 34, which require those companies to disclose all pertinent information in order to protect investors and to be able to regulate the way that those securities are sold. Now, why do I bring that up? Well, I bring that up because when you look at one of the biggest opportunities for a scammer that wants to try to take your money, it is the unregulated world of DeFi. And this is a sector that, as of the time of this recording, does not have securities laws in terms of the information that is required to present back to the investor, doesn't have any requirements in regards to background checks and ultimately registrations that that person needs to undertake. Now, mind you, if you're selling in the United States and it's a security, you do have to abide by the law. And ultimately, it creates this Wild West scenario in many cases where scammers are able to hide things below the overall surface level in the contracts in order to potentially take your money. And this is what we're seeing right now, especially in the DeFi sector. And what we're going to do is first talk about 3 of the common ways that these scammers are pulling the rug, otherwise pulling the liquidity, leaving you with basically a worthless token that you could start to avoid as we learn some of the tips and tricks, later on in this video. So the first trick, the first scam that these people will do when they create a token in order to resemble a legitimate utility or legitimate, framework of value is to first build a token that appears to have a lot of high APY or APR. APR is just simply your annual return. APY is that annual return compounded. That's the difference between APR and APY. And what they'll do is they'll offer these huge numbers, 1,000%, 5,000%, 10,000%, getting people so excited. And what happens is that people will go buy this token and then subsequently stake it or offer it as liquidity on these platforms. And this is where things get really dangerous. And the first way that these scammers are potentially taking your money is ultimately not locking their liquidity when they create the contract, meaning that at any point they could liquidate the entire pool, take all of your valuable ether that you're putting up generally as part of a farm, or if you're staking, ether in order to receive more of that token, they're taking your valuable token and ultimately leaving you with a token that's worth nothing. So if you had, 1,000% APY in a farm, you're going to farm, you have a 50-50 split of, token A, which is the scam token, and ETH. And ultimately, you feel good. 24 hours goes by, 48 hours goes by, you go to bed at night, you feel great. The next morning, you can wake up and realize your token's worth nothing because that scammer in the smart contract that ultimately dictates that pool has decided to pull out all the ETH, leaving these worthless tokens ultimately to crash. So one of the main ways is to make sure that there's a lock for the founder or the founding team where they can't just pull that liquidity out at any given time. The second is around supply. And one of the most common ways that rug pulls occur is ultimately the full authority for the founder or founding team to mint an unlimited supply of that token. And then subsequently, what they'll do is dump it on the market. So think of, dilution on steroids. They will create this token that's ultimately getting a lot of buzz and momentum because they have these really high APYs on their site. People are flooding in, they're aping, hand over fist. And ultimately, what these people will do, oftentimes in an inopportune time, in the US or an inopportune time if most of their investors are coming from Asia, is overnight, they will just flood the market, sell it at a huge discount, but ultimately they're stealing all of those, all the money that all of those investors legitimately thought was a great project. And the third piece here, which is something that is extremely sketchy, and it just became very apparent for a project that is related to Convex, which is tied into Curve protocol, where on these lending platforms where you mint in order to be able to purchase other tokens, what happens is that the price that is associated with the asset that you're putting up in order to mint this artificial, let's call it algorithmic stablecoin, you have to trust that the price that's being pulled into that platform is the right price and is being pulled in from a reputable oracle like Band Protocol or Chainlink. And what happens is that in the source code, these founders will actually tie the price to just a random fixed number in the founder's hot wallet. Now, again, I'm not going to call out this particular protocol for a number of reasons, but it's already made its round around Twitter. So certainly take a look around potential scams involving CVX or scams that are trying to take advantage of CVX. CVX is a legitimate platform, certainly not disclaiming them in any way, but you have to look at some of the ways that if you're putting up assets or collateral for lending, where are the prices coming from that ultimately dictate whether or not your collateral gets liquidated, allowing that platform, that protocol that you initially put up, your ETH or DAI, to just take your money because it arbitrarily said that you went below your collateral ratio. And this is something that is something new. I haven't seen it too often in this space. So please keep an eye on it. So with that being said, because we just talked about three things that are fairly technical, let me talk about what you could do, three ways that really don't involve any technical skills at all. And the first, check their social media. So there are two different things that you should be looking at here. One is what is the following or what is the overall social support for the overall project itself. If a project is going out saying we're going to sell 10,000% APY, we have all these great partnerships, and they have 1,000 followers, probably a red flag. I would then go on and take a look at what are the conversations in their Telegram and Discord look like. Oftentimes what you'll see when you go into their Telegram is that it's just a flood of people who are just promoting the app, saying it's going to go to the moon, putting up GIFs, really nothing of real substance or value outside of just being cheerleaders. Here's how you could test. Ask them a hard question. Don't be offensive. Don't ask to be rude, but ask them a question. and see if they respond. If they respond in a very thoughtful way, this could be a legitimate project that's just starting out. Oftentimes, though, you might get muted. You might even get banned from that group. And that might be a gift because you just saved yourself potentially aping into a project that is really on borrowed time. It's going to take your money. Second thing that you could start to look for is very simple. Has it been audited? So there are firms out there, Hacken, Consensus, Certic, blockchain auditing firms that have decades of combined experience looking at smart contracts. They know the loopholes that a lot of these developers are trying to exploit. And ultimately, they are looking at whether or not you are putting yourself in danger. Now, in saying that, don't just go with the fact that this platform says we've been audited, because if you don't read what the audit says, you might be putting yourself in some danger here. The audit might say, stay away at all costs. They're going to steal your money. Danger, danger, danger. But ultimately, it's still an audit. So make sure that you read that audit. Make sure that whatever Certic, puts out as sort of their POV is positive, or that if there are things that need to be addressed, that they're being addressed. Now, the caveat here is that these audits can be somewhat expensive. And ultimately, oftentimes, many of these auditing platforms have a backlog of projects that are in the queue. So the third thing that you could do that don't involve any technical skill, go on one of the independent auditing websites. There are websites out there that are actively looking at projects from their independent POV, meaning they're not getting paid by that project, but they're doing an analysis of whether or not investors are at risk. And there are some phenomenal platforms that are out there. Token Sniffer, RugDoc. I mean, these are great platforms that offer a tremendous amount of value for people who either don't have the time or simply just aren't that technical. Make it really easy to understand. Is this something that ultimately could lead to some pretty significant losses on your part? So I would certainly recommend going to those websites. If they're not, your project that you're evaluating is not on those sites, there are dozens of Telegram groups of coders, of technical people who have put together these groups to look at projects that ultimately may have been missed by some of the larger auditing sites, or they're just emerging. These groups will take a look at these projects. If you go in and you say, hey, I'm thinking about X, Y, and Z finance or X, Y, and Z protocol, they'll go back, they'll take a look and tell you, hey, here are things that we think are alarming. Here are things that you might want to be mindful of, and ultimately give you the information in very simple terms so you can make an informed decision. And ultimately doesn't require you to have to know a programming language like Solidity or Rust. Doesn't require you to know the ins and outs of a smart contract. It just basically, you are putting your trust in professionals, just like you would go see a dentist in order to fix your teeth. You're trusting people who specialize in this particular area to help guide you along the way. Just like you are coming to this channel so that we can guide you on emerging trends and opportunities. So with that being said, that's a great segue. I hope you enjoyed this video. If you did, please, again, subscribe to this channel, leave comments. We love to hear what you think. If there are topics that you want us to cover, we're certainly open. And until next time, happy and safe investing. I'll speak with you soon.